everybody. This week we're going to talk about current and contingent liabilities. We want to first make certain that we are all on the same page. What is a liability? For many of us, we owe somebody something. We may owe them to pay our credit card. We may owe for our mortgage. We may owe for our car note. Those are called liabilities. A liability is some obligation to release some kind of asset. In most cases, you're going to release your asset of cash, but not all obligations are paid with cash. So we're going to talk about those obligations, but in particular, we want to talk about obligations that are due within 12 months. Also, contingent, what does that mean? We're going to talk about liabilities that are really not true liabilities, but if something happens, then we have an obligation. Those are contingent on some event. So we're going to talk about those in the accounting and treatment for them. As always, remember the learning objectives for each chapter is very important because you need to know what it is that you must know before proceeding to the next chapter. You need to understand what it is that you're reading, why you're reading it, and the skills that you'll need to attain to ensure that you've learned what you need to learn in this chapter. So what is the difference between a current and long-term liability? Easy. We're going to talk about some specific liabilities like accounts payable and so forth. We're going to talk about other types of obligations like notes payable and the interest necessarily accrued. We're going to talk about some other accrued liabilities and unearned revenue. And we're going to learn how to account for contingent liabilities. So in all of these, again, most of the time you'll see in your textbook a company and its comparative balance sheet or income statement, depending on what we're talking about, and how it all looks side by side. The areas that we're going to be focusing on is the current liabilities, and you see here in the section where this is a consolidated, well, I wouldn't say consolidated, it was a comparative balance sheet, and it also shows you the information segmented. So it's pretty much giving you the current assets and your current liabilities, and you're separating them, so it's very clear what's liabilities in this case. So we're going to be talking about payables and accrued expenses and unearned and all of that sort of thing. We're not going to touch long-term debt. But in the end of the day, we all very much familiar with some current liabilities. We all also are familiar with long-term debt, and that includes our student loans. So what's the difference between the two? We're going to be talking about liabilities that are really going to be payable within a year, an operating cycle or a year. Either one, generally speaking, is going to be 12 months, 12 consecutive months. An operating cycle could be July to June, which is why we say within 1 year. But in the end, if it's going to be with payable or due or matures within 12 months, we are going to say this is a current liability. Obviously, current liabilities are really operational. And that's the case. Accounts payable is a true example of an operational liability that's current. And if it's due to more than a year, meaning if you have a long-term liability, but then part of that liability that you have to pay back has a short-term portion of it or a portion of that just due within 12 months, you'll see one obligation but split into different categories. One is a short-term portion, and then the other is a long-term portion of that obligation. And that's very, very important to note. Note payables are like that. Mortgage payables are like that. They may have cases where part of the liability or the principal that's due to be paid back is due in 12 months, 9 months, or whatever, which is short-term. But then they still have the remaining, which is due in 3 to 5 years or so forth. Same is true for bonds. If you have a serial bond, and a serial bond generally is a long-term debt, generally speaking. However, serial bonds are just that. They have multiple maturity dates. And that means that there may be times when that bond, which is typically a long-term liability, is actually current, at least part of it. And so you need to know that, particularly those of you who are continuing on to intermediate accounting and principles too, you're going to really see that a lot. You're going to see a debt that's being one specific debt that has a short-term part of it and a long-term part of it, and you need to be able to make certain that you are accounting for it accurately to present the information on the balance sheet. So again, this little exhibit is really kind of cute because it does give you examples right off the bat. What is a current liability and how they look and examples. So I would say memorize that. Don't worry about all of the different ones. I think major ones you will be really looking at would be accounts payable and notes payable and interest associated. You may see some accrued wages. And again, with your project, you're going to see that quite a bit. So the other items, warranties and income tax, you won't see too much really, but know what they are. And then generally they're going to be a current liability. So So account for accounts payable and accounts payable turnover. Now, again, if you are working with a vendor, I'm a company A, and I purchase supplies with this vendor. The vendor, kind enough, extended me credit. Accounts payable is generally extending credit, a non-interest bearing credit. Okay, generally accounts payables are non-interest bearing obligations, and they are most certainly very, very short term. 30 days, 45 days, sometimes 60, depending on the arrangement with the organization. So, accounts payable is going to be operational. You're going to be buying services or purchases, some type of product from your vendor, and you're going to pay it within a certain amount of time. And so those obligations are going to show up on your balance sheet in the current side of it. It measures really what you're actually purchasing as an operational type of thing. And you're going to see that quite a bit when you're talking about with your project. You're going to see that a lot with your transactions. I purchased, XYZ company purchases $10,000 of supplies on account. So you're going to have to say, okay, what did I receive for this transaction? I received an asset, office supply. So I'm going to debit that. But then it says on account. That tells you that you did not release cash. You did not pay for it at that time of the purchase. You have to pay that later. On account for operational type of transaction is almost always going to be attributable to accounts payable. So your offset or your credit is going to be accounts payable for that amount of the sale. Now, measuring how many times the organization is able to pay its accounts payable. This is so important because organizations that actually review and analyze the financial statements are going to understand, want to know how quickly they pay their bills. Now, paying within 30 days is not a bad thing. It really isn't. If you pay your bill within 30 days and it's due within 30 days, you're doing what you're expected. You're honoring your obligation. But there are times when organizations may pay quicker than that. And why would they pay quicker? Well, if they're given an incentive, a discount, if you pay within 15 days, you get a 1% discount on your gross amount of your sale. Organizations who have the cash flow to do it actually may want to take advantage of paying the vendor before the 30 days. There are some more complex issues here, but in the end of the day, if you have excess cash and it's idle, you don't want to leave it in your bank account. You want to either have that money earning interest for you, or you want to pay your obligations earlier. And if you pay your obligations earlier and you receive a discount, that's an extreme positive bonus. And it does have an impact on your turnover, your accounts payable turnover. How likely, how well this organization is turning over their accounts payable. Another ratio that I think is very, very important when you want to look at the organization as a whole, not necessarily specific transactions, but as a whole, how well is this organization doing? So let's take a look at, now we think about having to analyze the accounts payable turnover. Be aware that when you're trying to calculate your purchases from suppliers, you may have to do a computation using your inventory. And we'll talk about that when we analyze our inventory in our project and our homework. But the major point of this turnover truly is to determine how efficient the organization is using its cash, how liquid this organization is. And those are more important types of questions that an organization needs to respond to, because if you're not paying your bills quickly or on timely, that may very well be an issue of cash flow, and you need to evaluate that and rectify those issues. So the main point of the ratios really for internal purposes is to make certain that the organization is on track. So for us to analyze accounts payable, we want to be able to say that when we are looking at purchases that we make from our suppliers, and again, suppliers in this context is really about when we're buying supplies that we're going to either resell, and that's part of our inventory. So when we buy supplies and we're going to resell those items, it becomes a little skewed as to what our purchases really are, because we have to go back and look at our inventory account and evaluate that and analyze the transaction so we can assure ourselves if this is what our actual purchases are, so that when we calculate our turnover, we can have an accurate picture of of how well we're using our monies and how quickly we are paying our bills. So when we are analyzing our turnovers, we are telling them that we pay our bills very, very quickly. We are using our payment, we are meeting our obligations. So a higher turnover is really better. But when you're looking at ratios, it's important to note that they're not to be looked at in isolation. They really are important when you're looking at them through the lens of a comparison, comparing it with other organizations, within your industry. If you're in retail, other retail organizations. Why? Because that is a very good measure. Are you on par with your peers? That's a benchmark. Are you above, doing better than your peers, or are you doing below your peers? So ratios are good. Comparing ratios with industry and other benchmarks is even better. So notes payable. Let's talk about notes payable. What is a note payable? Generally, a note is going to be like a car payment, because you are actually writing or signing a promissory note to pay back the loan on that vehicle over a certain period of time, and you are charged interest. So this is very different from accounts payable. First of all, notes payable is generally not operational. Number two, note payable generally is secured by some kind of asset, so they're a secured debt, generally speaking, of course. Also, a note payable has an interest rate tied to it, and also it is generally speaking long term, not always, generally. As we note that there are some notes payables that are short term, or a long term note that has a short term portion to it. So these are the things that distinguish it from an operational or an other type of liability. So when we're talking about those types of obligations, generally it's a formal type of thing. It's a really big deal, and you're going to be paying for this over a period of time. So we need to make certain that they are recorded accurately from the onset, and we have to let people know that the price of me borrowing this money means we have to pay interest. That's extremely important. So, and we don't want to mix the two, meaning I want to show my obligation for my note payable, the principal portion only, and I want to show separately the interest that I'm obligated to pay, whether it be in 6 months, whether it be in a year, etc. Generally, interest payments are going to be short term, which means you're going to have to pay your interest over time, but within the same operating cycle. Again, we're going to make some assumptions here that accrued interest is going to be a short term, which means you'll be paying it over, within one operating cycle. Here is the inventory that was purchased in January, and they actually purchased it with a value of $8,000, but they did not pay it in cash. They did it in exchange for a short-term note, which is due in 1 year with an interest. As you can tell, it's still short-term because it met the 12-month or the one operating cycle period, that criteria. It also has an interest rate tied to it, which is very different from operational obligations like an accounts payable. So that's very, very important. Also, we purchased an asset, so we have to include this, our entry. On January the 1st, we're going to have to record a $8,000 debit to our inventory, because that's the asset that we purchased for a debt instrument. And we're going to record a note payable, and here you notice it says short term. Very, very important. The presentation of this note on the balance sheet is going to be critical, because it will throw off everything. You'll say it is a short-term obligation when it's really a long-term, or it's going to be long-term when it's short-term. You really need to be very clear when you record these transactions that it is a short-term obligation, and your instructions generally should tell you that, or it will tell you something to lead you to believe that this obligation has to be paid within an operating cycle, and that's very important. But as you can see here, we are not recording, if you can tell, we're not recording the interest part of it. All we're doing at this point is the obligation and the receipt of the asset. So we're following the rules with regard to our assets equal to liabilities plus stockholders' equity, and we're also making certain that the entry is only showing the actual exchange. Now, if we look into the fiscal period, we're getting ready to close our year. We have to show an obligation of interest as a result of that transaction. So here we are. We're going to show our interest expense and our payable. Remember, we did not pay it yet. We have to show that we are obligated to pay. Unless it tells you that you paid it, you have to assume an obligation. So we're going to calculate it using simple interest, nothing more major complicated. We're going to just multiply the amount of the debt, which is in this case $8,000, times the rate of interest times the time. In this case, we're talking from January to the end of September, which is full 9 months out of 12. So here we have here $600 in interest, and we have an obligation which we increase, and we have a expense which we are showing a decrease in equity. Remember, in equity goes up with revenues, goes down with expenses. An expense is a reduction in equity. So here we have it. In January of 2019, the payment has been made. We're going to make a payment for not only the principal amount of the debt plus the interest. And if you can see here, from October 1 to December 31st, there's 3 months worth of interest that we have yet to accrue. And you'll see that as interest expense times the rate of interest times 3/12. Then we have to remove the obligation that we recorded it previously in September. $600. We're going to debit that. We're going to remove the obligation. Remember, the decrease in obligation, we have to debit that. So we have an $8,000 debit. So we have all of our debits. Now we know we can back into what our cash outlay is. So when we have notes that have a maturity that is within 12 months, we have to make certain that we show the obligation is a current obligation. There are obligations that have two pieces to it. One part of it's due within 12 months, and the other part is due after or longer than 12 months, and they will be shown separately on the balance sheet. And that's a critical point that you need to know, because you don't want to show all of your obligation as long-term when you know for a fact, and everybody needs to know, that part of that obligation needs to be paid within 12 months. You will be misleading people who are reading and using your financial information. So it's very important to disclose that and to record them separate. Same obligation, different time periods of payment of the principal amount. One part of it is short-term, and the other portion of it is long-term. And that's very common with some debts. Serial bonds is one example of that. Now, our learning objective number 4 is accrued liabilities and unearned revenue. Okay, why do we accrue? We recognize something when it's incurred, and we need to match it with the revenues in the same period. We incur this expense, but we need to write this expense or record this expense and match it in the same time period with the revenues that it's generating. That's the matching principle, which means we have to accrue for it. And it has to be something that we have not recorded already. So again, if we have some kind of obligation or we have some kind of expenses that we've incurred and it has not been recorded, we need to record it and match it in the same time frame. And that's generally through an accrual entry. So liabilities are such as that. And again, payroll and other types of obligations have the same type of logic. We want to make certain that we show that we have some sort of obligation to pay, and we have not recorded that obligation. Example, sales tax. Home Depot have sales of $200,000. They deduct 5 or they add 5% to the sale. You and I have to pay it. Well, they at some point have to remit that money to the jurisdiction, whether it be the state of Maryland, whether it be the state of Commonwealth of Pennsylvania. They have to remit that money, whether it be monthly, quarterly, however the arrangement is. But at some point they have to show that obligation. Now, they are not showing an expense. It's not their expense to pay. But just that when they take that money from you and me in the form of a sale that we have transacted, they are obligated to remit on our behalf that sales tax to the local government. And here is an entry. Payroll liability is the same thing. Again, you get paid your salary, but guess what? You and I don't get our gross paychecks. We get our net paychecks. What happens with the difference? Our difference could very well be because of taxes that are withheld from our pay, or health insurance, or other type of deductions. Let's talk about payroll liabilities, which is the 401, which is the Social Security and Medicare, or the federal withholding. Those items are withheld from our paycheck, and they have to remit at some point, semi-weekly, once a month, once a quarter, to the federal government as well as to state local jurisdictions. Okay, that means on our books as employers, we have to record that obligation. Now, we don't have an expense necessarily unless it's the matching part of the Social Security and Medicare, but the federal withholding and the state withholding, we don't have an obligation. I mean, we don't have an expense there, but we still are obligated to take it from their paychecks and then remit it on behalf. And that's how we're doing these types of transactions. We have to not only take care of the salary expense, which is the gross amount of what you and I get paid, but then at the same time, we have to deal with the obligations to pay back the jurisdictions for whatever we withheld. In this case, employee tax withholding, FICA, and then if you can see at the bottom here, the last entry would be salary payable. And again, salary payable is going to be what is remitted to the employee at some point. When you accrue for it, generally you haven't paid them yet. So you have to show an obligation to pay them at some point for that for their salaries. Again, salary expense is going to represent the gross pay. Salary expense is going to create some liabilities. You're going to have to show what you withheld, and you're going to have to show what you have, and that includes not just taxes also, but it's also related to any kind of withholding like health insurance. That's a withholding you have to remit to the health insurance provider, or you have to reduce your expense because they are actually paying you. So again, when you're dealing with employees, gross amount is going to be your expense, the net amount is going to be your salary payable, and that difference is going to be, generally speaking, withholding, whether it be state taxes or FICA and Social Security. Now, unearned revenue, warranties are an example. If you purchase an iPhone, not say you purchase an iPhone, let's say you purchase a computer, and you want to make certain that if anything goes wrong with it outside that 1 year warranty period that they give you when you buy it, you pay additional 2 years. That 2 years worth of warranty is unearned for the organization that's selling you the policy or selling you the warranty. They have to set that money inside of an unearned account. Why? Because until that period of 1 year is lapsed, that extra 2 years is not yet their money. They have an obligation to provide you a warranty. And that warranty agreement does not start until 12 months after the time you purchase it. So for that 2 years that you purchase a warranty, that's an unearned revenue. That's an obligation. They have to provide you some sort of warranty or some type of warranty that if anything happens within a certain period of time, they will make repairs or replace your product. So until that period of time comes, it's an obligation. So they are indebted to you to provide a service. And so when you're dealing with warranties, that's exactly the entry. You're going to record a increase in cash, but you're going to record an obligation to pay or to fulfill the terms of the warranty. So that's what we're going to do here. And again, suppose Black & Decker made sales of $100,000 subject to product warranties, and in the past years 2 to 4% of the products were defective. If the Decker could estimate that 3% of the sales will require replacement of those items, Black & Decker would estimate that the warranty expense was $3,000 for the year and make the following entry. This is assuming that Black & Decker has said the first year I'm going to warrant my products. Every product that I sell to you, I'm warranted for the first year. And this entry here is saying I suspect that of that 1 year period of time, 3%, 4%, or whatever that percentage is going to come back defective. And they have to record that entry. They have to record an expense of warranty and an obligation to meet that replacement guarantee. And that's going to be the entry here. Suppose the actual defects add up to only $2,800. Decker will replace the products and then record the following entry. So now they have to make certain that they remove the obligation because they actually replaced them. They've actually replaced the products that were defective. So they have to reduce their inventory, which is an asset, by $2,800. Remember, we're not going to be dealing with cash. When you're dealing with warranties, a lot of times they have to provide a service or replace the product. In this case, no cash is in this entry. We're reducing the asset because they actually said that we are going to replace products that are defective. And that by doing so, they're reducing their inventory. And at the same time, they're reducing the obligation to honor the warranty. So unearned revenues is another type of item that you can deal with. Suppose you have received $10,000 from your customer and you are to provide them with a service, but you have not done the service yet, or you have not provided the product yet, but you got the cash. You got to record something. And in this case, you have received money and you have not completed the work. The work has not been substantially completed. As a result of that, a prepayment, etc., will incur some type of unearned revenue. And an unearned revenue is a obligation. You are obligated to provide that service. So let's use an example here. You have, in June 30th, Amazon collected $3 million for 1 year memberships for Amazon Prime. Very, very common transaction. They charge us $195 or more every year, and they have over 10,000 customers. Equals $1.9 million or $3 million. But that year of membership, you can't just record revenues right off the bat. You have to allocate that revenue proportionately over the year if you're going to do the accounting right. So for example, if June the 30th we receive cash for July 1 through June 30th of the following year, guess what? That transaction is unearned. You have to show an increase in your cash, but you have to show an obligation to provide the service to your customers proportionately over that 1 year. So 1/12 every single month, you have to record the revenue. And we could show that. I think there's an entry here. Very good. Here we are. Now, every month that organization has to record, in this case, we're showing the entry at the end of the year, but every month Amazon would have to show or reflect in their financial statements 1/12 of what they have earned in their transactions. So here we are showing $3 million and 1/2 of it, but I would say 1/12 every single month until that particular obligation has been satisfied. And the entry will be the same. We're reducing the obligation, which is a debit to unearned revenue, and now we can recognize the revenue. So now real quick, let's go into contingent liabilities. Contingent liabilities are going to be a potential that something is going to happen based on a past event. If you're being sued, for example, and there's a possibility that because of something that happened in the past, they're going to come after you, and you are suspected of maybe having to pay out X amount of money. You believe that you're not going to win this liability or this lawsuit. So if you had that type of obligation or potential of obligation, it is considered a contingent obligation, a contingent liability. So what you have to do is you have to make certain that you have to determine if it's a probable loss and you can reasonably estimate that, you need to account for it. Or if you have, is a reasonably possible a loss will occur, and you have to disclose it in your financial statements. You may not be able to record it because you don't necessarily know what the amount is. So that disclosing it would be sufficient. And if it's highly unlikely to occur, you do nothing. You don't record it, and you most certainly don't disclose. And all of this is really just giving you a taste of it, because this really goes into intermediate accounting, which you probably will see later on. But just in general, if we know we're going to lose money and we can estimate it, we record it. If we know, but we can't really give you a good item or dollar amount, we can reasonably think that we might have an obligation to pay the lawsuit, we'll disclose it. If there's a unlikelihood of this going against us, we do nothing. We do not record anything, and we do not disclose anything. We just ignore it. And again, in your particular homework and in your chapter, you can go through the scenario, but this is something that really is more advanced, and I just want you to get an idea of how organizations handle transactions such as these. Again, thank you very much for your time, and I really appreciate it, and hopefully we'll talk again in our future chapters. Take care.